Waiting just 5 years to start investing secretly destroys half of your retirement wealth forever. So what is the one invisible variable quietly robbing your future before you even turn 30? Picture two friends, both starting with the exact same goal, financial freedom. Mark decides to start investing just $200 a month at age 22. His friend David decides to wait, believing he has plenty of time and needs to enjoy his youth first. By the time David finally starts at age 32, Mark has already accumulated a massive head start that David can almost never catch. The difference between them wasn't luck, stock picking, or earning a massive salary. It was simply one invisible force that works silently in the background: time. What if waiting just 10 years cost you over $500,000? Stay until the end, because the numbers at Scene 20 will completely change how you view every single dollar in your pocket today. When you are young, money feels like something meant strictly to be spent and enjoyed. You get your first real paycheck, and the impulse is to upgrade your lifestyle immediately. You buy the modern smartphone, dine at high-end restaurants, and take expensive weekend trips. There is absolutely nothing wrong with enjoying your life today, but most people misunderstand what money actually represents. Money isn't just paper currency or numbers inside a banking application. It is stored human time and future potential. Every $100 bill you spend today on temporary pleasure is actually a worker you fired from your future financial team. When you realize that money can work harder than you ever can, your entire mindset shifts completely. Let's look at the secret engine that creates true wealth across generations: compound interest. Albert Einstein famously called compound interest the eighth wonder of the world for a very good reason. He who understands it, earns it. He who doesn't, pays it. Compound interest simply means earning interest not just on your initial money, but on the interest itself over time. In the early years, the growth looks so ridiculously slow that most people give up entirely. You invest $2,000, and after a full year, you might only see a small $200 gain. But like a tiny snowball rolling down a massive snowy mountain, time transforms that small trickling gain into an unstoppable avalanche. Let's analyze Mark's exact financial breakdown to see how this magic actually unfolds in real life. Mark invests $200 every single month starting at age 22 without skipping a beat. Assuming an average annual return of 8%, Mark puts in $2,400 every year. By age 32, after 10 consistent years, he has personally deposited $24,000 total. At this exact point, Mark stops contributing entirely and never adds another single dollar to the account. His money continues to sit in the market, growing quietly in the background while Mark goes on with his life. By age 62, his initial $24,000 grows into over $400,000 automatically. Now let me introduce you to David, who took a completely different path toward his retirement goals. David spent his 20s enjoying every single paycheck, buying cars, gadgets, and living in the moment. At age 32, David looks at Mark's growing portfolio and realizes it is finally time to start investing. David commits to investing $200 every single month, just like Mark did earlier. However, to try and match Mark, David continues investing $200 every month for 30 straight years. David invests all the way until he turns 62, putting in a grand total of $72,000. Despite putting in 3 times more out-of-pocket money than Mark, David ends up with significantly less overall wealth. When both men reach age 62, the final financial numbers leave David completely speechlessly shocked. Mark's total balance sits comfortably at approximately $430,000 from his early head start. David's total balance reaches around $280,000, despite 30 years of nonstop labor. Mark ended up with over $150,000 more while investing $48,000 less out of pocket. How is this mathematical reality even possible when David worked and saved for 3 times longer? The secret answer is that Mark's early dollars had 10 extra years of exponential compounding growth. Those 10 years in his 20s did more heavy lifting than 30 years of hard manual labor later. This fundamental financial principle is known among elite investors as the opportunity cost of time. Every single year you delay investing, the future cost of reaching your financial goals increases exponentially. Delaying your start by 5 years doesn't just mean losing 5 years of simple market gains. It means sacrificing the final 5 years of compound interest, where the absolute biggest growth happens. In the final years of an investment journey, your portfolio can grow more in 12 months than in your entire first decade combined. Time is the only asset that is distributed equally to every human, but used completely differently. The greatest luxury in investing isn't having millions of dollars. It is having decades of runway ahead. Many people look at their current bank account and say, "I only have $50, so why bother?" This mental trap prevents millions of hardworking people from ever starting their personal wealth-building journey. They believe that investing is reserved exclusively for wealthy corporate executives or high-earning individuals. But investing $50 a month early is far superior to investing $500 a month late. Small, consistent actions multiplied by time always beat massive, sporadic efforts applied too late in life. The stock market does not care about your job title or your current social status. It only cares about how long your dollars are allowed to sit and compound continuously. Let's talk about inflation and why sitting on plain cash in a savings account guarantees loss. Keeping your hard-earned dollars in a traditional bank paying 0.01% feels safe. However, inflation quietly erodes the actual purchasing power of your hidden cash every single year. A basket of everyday goods that costs $100 today will cost much more in 10 years. If your money isn't earning a rate higher than annual inflation, you are guaranteed to lose value. Investing early is not just about growing rich. It is about defending your purchasing power against time. Building an asset portfolio is your personal armor against the relentless loss of real cash value. Consider the concept of life flexibility and freedom that early investing creates for your future self. When you build a solid financial cushion early, you gain the power to make life decisions without fear. You aren't trapped in a toxic workplace environment simply because you need next week's paycheck. You can pivot careers, launch your dream business, or take a sabbatical without financial panic. Money buys options, and having options early in life changes your psychological well-being completely. An emergency fund combined with a growing investment account acts as a powerful safety net for life. You shift from living defensively in survival mode to living offensively with vision and confidence. Let's explore how market volatility affects early investors compared to older investors nearing retirement. When you start investing in your early 20s, market dips and crashes are actually fantastic news. A market downturn allows you to buy high-quality index funds and stocks at a massive discount. You welcome price drops because you have decades left to hold and watch prices recover completely. However, if you wait until age 50 to begin, market volatility becomes a terrifying daily stressor. You no longer have the luxury of waiting 10 years for the economy to recover from a recession. Starting early gives you the superpower of time, turning market drops into long-term opportunities. Understanding the difference between active income and passive investment income is crucial for financial success. Active income requires your direct physical presence, time, and active labor to earn every single dollar. If you stop working your daily 9-to-5 job, your active income stream instantly dries up completely. Passive income, on the other hand, flows into your life regardless of whether you are sleeping or awake. Early investments generate dividends and capital appreciation that flow automatically without extra physical effort. When your passive investment income eventually surpasses your monthly lifestyle expenses, you become truly financially free. The earlier you plant these financial seeds, the sooner you can sit under their protective shade. Let's analyze another common misconception: waiting until you earn a higher income before starting. Thousands of young workers say, "I will start investing once I make 6 figures a year." But lifestyle inflation almost always rises to match whatever new salary you end up earning. When your pay increases, people naturally buy nicer cars, rent bigger apartments, and spend more freely. If you don't build the habit of saving on a small income, you won't save on a large one. Financial discipline is like a physical muscle that must be trained continuously with small weights first. Master managing $500 today, and you will easily manage $500,000 tomorrow. Automating your monthly investments is the single most powerful strategy to guarantee consistent success over time. When you rely on pure willpower every month, life always finds a way to disrupt your plans. An unexpected night out, a tempting sale, or a minor emergency will convince you to skip investing. By setting up automatic monthly transfers on your payday, you eliminate human emotion and temptation entirely. You pay your future self first before spending a single dollar on temporary consumer desires. This out of sight, out of mind technique turns financial growth into an effortless background habit. Over 10, 20, or 30 years, this single automated decision creates life-changing financial wealth. The psychological peace of mind that comes from early investing is completely priceless and life-changing. Money worries are one of the leading causes of daily stress, anxiety, and sleepless nights worldwide. Knowing that you have compound growth working for you reduces future financial fear dramatically over time. You no longer dread unexpected car repairs, medical bills, or temporary economic market downturns. You move through life with a calm confidence, knowing your future is secured by solid assets. This peace of mind allows you to focus on health, family, relationships, and personal passions. Early investing isn't about greed. It's about buying ultimate peace in an uncertain world. Let's address the mistake of trying to time the market instead of spending time in the market. Many beginners delay starting because they are waiting for the perfect market crash to buy cheap. They spend years sitting on the sidelines, watching prices rise higher and higher while holding cash. Wall Street data consistently proves that time in the market always beats timing the market completely. Missing just the 10 best market trading days over a 20-year period cuts your final returns in half. The best time to start investing was 20 years ago. The second best time is right now today. Stop waiting for the perfect market conditions and let consistency do the hard work for you. Where should a beginner actually start investing their hard-earned dollars today without feeling overwhelmed? You don't need to read complex financial reports or analyze individual corporate stock balance sheets daily. Low-cost broad market index funds, such as those tracking the S&P 500, offer instant diversification. An S&P 500 index fund lets you instantly own a tiny piece of America's top 500 companies. Over historical decades, the overall broad stock market has yielded an average annual return around 7 to 10%. By holding broad index funds early, you bet on the overall long-term growth of human innovation and productivity. Let's project what happens if you increase your monthly contribution as your career advances over time. Starting with $200 a month at 22 establishes your foundational wealth habits early on. But as you receive job promotions, salary raises, or side hustle income, you can step up contributions. Raising your investment from $200 to $500 monthly accelerates your financial timeline drastically. At an 8% return, $500 a month over 30 years becomes over $700,000. You aren't locking yourself into a rigid fixed box. You are opening a growing compounding engine. The key is simply establishing the initial habit immediately, regardless of how modest the starting amount is. Let's contrast two ultimate life paths when both individuals reach their retirement age in 60 years. Path A is David's path, delaying action, working harder for decades, and constantly stressing about missed opportunities. Path B is Mark's path, taking small automated action early, letting time do 90% of the work. Mark reaches retirement with abundant options, high financial security, and zero regrets about his younger choices. The difference between these two life outcomes wasn't intelligence, rich parents, or lucky stock picks. It was simply the courage to start early and stay consistent when nobody else was paying attention. Which of these two paths are you actively building right now with your daily financial decisions? Now that you see the undeniable math behind compound interest, the real question is, what will you do today? Will you be like David and delay another year? Or like Mark and make your first move right now? Every single month you wait costs your future self thousands of dollars in lost compounding gains. You don't need thousands of dollars to begin. You just need the discipline to start with whatever you have. Open an investment account, set up a small automated contribution, and let time build your wealth quietly. If you had the power to give your future self $1 million or 10 extra years, which would you pick? Drop your answer in the comments below, subscribe for more money tips, and start investing today.